Ladies and gentlemen, Namaskar and welcome to Kotak Securities weekly commodity market audiocast. I'm your host and guide Ravindra Rao, and I'll be taking you through the latest updates and insights from the world of commodities. Whether you're a seasoned trader or someone new to the world of commodities, this audiocast aims to provide you with valuable information and analysis. Let's start with the macros first. Risky assets softened this week as hawkish comments by major global central banks have intensified fears of an economic slowdown. The move came amid elevated core inflation and a tight jobs market in most of the economies. Fed Chair Jerome Powell, in his testimony last week, emphasized the importance of fighting inflation and stated nearly all FOMC participants expect that it will be appropriate to continue raising rates this year and perhaps two more times. Powell also said the rate cuts won't happen anytime soon. This pushed the US 2-year Treasury yields, a proxy for short-term rates, near 16-year highs that was touched in early March 2023. Meanwhile, the yield on UK 2-year bonds rose above 5% for the first time since July 2008 as investors ramped up their bets on how fast and how far the Bank of England will raise interest rates. Dollar saw a sharp rebound from a low of 101.90 to 103 as fears of further tightening of monetary policy across the globe prompted investors to reprice interest rate expectations following a pause by Federal Reserve last week. Earlier in March, interest rate swaps were pricing in almost 100 basis point of rate cuts for the year as banking crisis unfolded. However, now not even a single 25 basis point rate cut is priced in for 2023. Price action is indicating a resistance in dollar index near 103.40 to 103.60 zone. A break of 101.90 on daily closing might pull it further lower towards April lows near 100.80. However, if the support holds, it might trade between 102 to 103.60 for the week. Moving to precious metals, COMEX Gold prices witnessed steepest weekly decline since January 2023 as major central banks kept hiking rates and markets are pushing back against rate cuts later this year. Silver prices tanked more than 7%. Rising yields across the board raises the opportunity cost for holding the non-yielding bullions, which can be seen in the ETF activity. Holdings at the SPDR Gold Trust ETF has been declining over the past few weeks and has seen outflows of more than 11 tons from 941.29 tons seen in May 2023 compared with 929.7 tons as on 22nd June. The Treasury yield curve is now inverted more than a percentage point as markets are pricing in higher rates for the medium term. From the price action front, spot gold in dollar has penetrated the support of 1930, which it was holding since long, and it closed near $1920 per ounce. Now 1930 to 34 zone, which was the support, would become the resistance, and the bears might target 1880, 1889 on the lower side, which is the next best support. If the bulls take it higher above 1934 to 1935, then there is a chance we might see some kind of a reversal. Otherwise, it looks slightly weaker for the week. Similarly, in case of silver, prices have moved quite low, but in case of silver, it is trading close to the 200-day moving average of $21.97, which we feel it might respect, and prices might give a bounce back. Having said that, crucial levels would be on the lower side 22.14 to 21.81, which is the 60-day moving average support. So until it is above 21.80 on a weekly closing basis, there is a possibility we might see some kind of a bounce back in prices. But if it penetrates 21.80, then there can be further downside. Otherwise, some bounce back is possible. Base metals and crude oil were no exception, as investors fear the efforts taken to cool down inflation may prove costly to economic growth, in turn affecting demand outlook. Besides, China's cut in benchmark lending rates for the first time in 10 months were seen as insufficient to reignite demand. On the price front, NYMEX crude oil continues to trade between $67 per barrel to $74 per barrel, which is expected to continue until the range breaks on the either side. But in case of natural, prices seem to be taking a good support, and it has in fact penetrated the resistance last week at the end prices moving higher. There is a possibility if it sustains above, this is for July contract on the MCX. If it sustains above 234 on a closing basis, then there is a chance we might see further upside in prices, and it might go higher towards 245 to 250. So natural gas is looking pretty good for the coming week. Support now is near 210. Below that, it might again turn a bit neutral. But if it goes above 234, then we might see a good rally in prices. In case of base metals, zinc is still a preferred bet because on weekly charts it has formed a bullish engulfing, and that might negate only if it goes below 204. So until that holds, zinc remains a preferred bet in case of the entire base metals pack. So for the coming week, speeches from major central bank chiefs, Fed's preferred PCE price index, US final GDP estimate, and goods orders are the economic events to be watched for. This might limit global risk appetite. Cooling of Fed's preferred inflation gauge may bring markets some relief, while sustained pressure may boost hawkish bets, weighing further on risk sentiments. Chinese data is likely to show signs of patchy recovery, which may strengthen views that more monetary easing will be needed to recharge the slowing economy. That's all for this edition of Commodity Market Audiocast. Stay tuned to our Telegram channel that brings you the latest updates from commodities trading world. Thank you for joining us. All the best and trade safe.